Have you ever dreamed of joining the Millionaire Club? Investing in the stock market remains one of the most tangible ways to turn that dream into reality. The smart money is always on the move, looking for the next big winners. So, which stocks are the best investment in 2024? In this video, we're breaking down 6 picks that could be your ticket to big returns. 1. Alphabet Inc. Sitting pretty in the trillion-dollar club, Alphabet, Google's parent company, is a tech titan with more than just a search. From Pixel phones to YouTube and a nest full of smart devices, Alphabet offers services that keep users glued to its ecosystem. JP Morgan crowned Alphabet a top stock for 2024 thanks to factors like rising ad revenue, sharp cost-cutting, and the ever-evolving world of AI. While their AI chat opponent, ChatGPT, has been basking in the limelight, Google's answer, Gemini, stumbled out of the gate. An image generation launch that went off the rails on race depictions left a black eye on the project. This year, these missteps have damaged the stock, creating a potential goldmine for long-term investors. Alphabet's cloud division, though still losing money, is strategically grabbing market share with profitability on the horizon, a move that could open the profit spigot. JP Morgan sees big things for Alphabet in 2024, citing factors like rising ad revenue, strategic cost cuts, and the exciting potential of artificial intelligence. While Google's AI answer, Gemini, hasn't quite captured the spotlight like its competitor ChatGPT, these factors have made Alphabet's stock a potential bargain for long-term investors. Notably, Alphabet's cloud division is strategically grabbing market share while operating at a loss. Once profitability kicks in, this could be a major moneymaker for the company. 2. Discover Financial Service. Now come to the next stock, which is DFS. With signs pointing towards a smooth economic landing, companies like Discover stand to gain if a recession is avoided. Despite being smaller than industry giants like Visa, MasterCard, and American Express, Discover distinguishes itself by extending loans to consumers. This reliance on consumer health underscores the importance of a robust American economy for Discover's prosperity. February of 2024 brought a surprising turn of events for DFS shareholders as they received an unexpected boost. Capital One Financial Core Dollars, COF, made headlines by announcing its agreement to acquire Discover in an all-stock transaction. This strategic move is poised to elevate the competitive landscape among credit card giants, fostering an even more formidable contender in the industry. However, the deal's finalization hinges on obtaining regulatory approvals and garnering shareholder consent, a process anticipated to conclude by late 2024 or early 2025. Under the terms of the acquisition, DFS shareholders are set to receive 1.0192 shares of COF for each DFS share they possess. This exchange rate translates into a notable premium of 15.4% over Discover's stock price as of March 4th, underscoring the confidence in the value and potential synergies of the combined entity. 3. Walt Disney Company. A recurrent contender from last year's selection, Disney stands tall as a powerhouse in the global entertainment sphere, boasting a diverse array of ventures spanning from its iconic theme parks and cruises to its extensive broadcast and streaming platforms, film studios, and beloved brands such as ESPN and Disney+. Under the stewardship of esteemed CEO Bob Iger, who reclaimed the helm in late 2022 amid escalating costs, the House of Mouse recently unveiled plans to ramp up its cost-saving initiatives by over 35%, elevating the target from $5.5 billion to $7.5 billion. Concurrently, activist investor Nelson Peltz has emerged on the scene. He argues for a shift away from reliance on sequels towards a more daring pursuit of original content, a move that could potentially inject fresh vitality into Disney's creative repertoire. In the third quarter, PDD experienced a remarkable 94% surge in revenue compared to the previous year, propelled predominantly by an astounding 315% increase in transaction revenue. Renowned for its budget-friendly offerings and mobile-centric online platforms, PDD entices consumers with its affordable products, complimentary shipping, and hassle-free 90-day return policy. With a forward earnings multiple of approximately 17, PDD appears exceptionally attractive from a valuation standpoint. However, the company faces notable risk factors, including the state of the Chinese economy and the extent of regulatory intervention by the Chinese Communist Party, exemplified by its 2021 crackdown on Chinese big tech firms. Despite these challenges, PDD has already established itself as a profitable entity, instilling confidence among shareholders regarding its enduring presence in the market. The recent underperformance of PDD's stock can be largely attributed to investors shifting sentiments away from Chinese equities. 4. Occidental Petroleum Corp. Next in the list is Occidental Petroleum Corp. As you know, the Oracle of Omaha, Buffett has been steadily augmenting his oil and natural gas holdings through his conglomerate Berkshire Hathaway Inc. BRKB. One particular beneficiary of his investment prowess is Oxy, a company trading at a valuation of less than 15 times forward earnings and offering a modest dividend yield of 1.4%. Oxy aligns with Buffett's investment criteria, representing a well-managed entity positioned within value stocks. Berkshire's initial foray into Oxy dates back to 2019, when it was pivotal in financing Occidental's acquisition of Anadarko Petroleum. Since then, Berkshire has steadily accumulated a substantial stake in Oxy, indicative of Buffett's growing confidence in the company's prospects. Securing regulatory approval to potentially acquire up to 50% ownership in Oxy, Berkshire has significantly bolstered its position from 196 million shares to nearly 248 million shares as of February 5th, thereby commanding approximately a 28% equity interest in the company. Buffett, renowned for seizing investment opportunities, has strategically timed his acquisitions of Oxy shares, often targeting instances when their value dips below $60. This deliberate approach has effectively established a stock price support level. Furthermore, in the funding agreement struck in 2019, Berkshire secured warrants enabling it to purchase an additional 83.8 million Oxy shares at $56.62 per share, further incentivizing Buffett to advocate for prices surpassing this threshold. Although Oxy encountered challenges amid declining energy prices in 2023, resulting in underperformance, any resurgence to higher oil prices in 2024 would bode well for the company. 5. Match Group Inc. Now comes Match Group, a dominant force in online dating, weathered a tumultuous period in recent years, experiencing declines in 2021, 2022, and 2023. Much of its prolonged downturn stemmed from the dual challenges of escalating interest rates and an already inflated stock valuation. At certain junctures in 2021, Match Group stock traded at an exorbitant multiple of 132 times forward earnings estimates. However, the pendulum has swung, and Match Group now presents an attractive proposition with a significantly lower forward price-to-earnings ratio of 12.7. Renowned for its ownership of premier online dating platforms such as Tinder, Hinge, Plenty of Fish, OkCupid, and Match.com, Match Group stands poised to capitalize on the ongoing secular growth trend in online dating. This trend is driven by the pervasive influence of smartphones among younger demographics, who increasingly defer marriage, reflected in the upward shift of the median age of first marriages in the U.S. to 30 for men and 28 for women, compared to 26 and 24 respectively in 1990. With projected earnings growth at an impressive compound annual rate of 26% over the next 5 years, Match Group emerges as a compelling investment opportunity in 2024, a company worth swiping right on. 6. Target Corp. Target Corp is also one of the top stock investments. While perhaps lacking the flashiness of some other stocks, TGT stands out for its reasonable pricing, mirroring its merchandise ethos. With a forward price-to-earnings ratio of just 17, Target offers a significant discount compared to competitors like Walmart, WMT, at 25, Costco, Cost at 48, and discount retailers Dollar Tree, DLTR, at 22, and Dollar General, DG, at 20. This discount seems unjustified, especially considering the company's projected earnings growth of 38% in 2024. Despite facing challenges in 2023, including the closure of 9 stores due to retail theft concerns and backlash from customers boycotting the retailer over its acknowledgement of Pride Month, Target remains a solid investment option. Throughout history, TGT has demonstrated resilience during economic downturns, benefiting from consumers' inclination to tighten their budgets and hunt for bargains at the big box store. Consequently, Target emerges as one of the more defensive options among the stocks under consideration. Moreover, income-oriented investors will appeal to Target's forward dividend yield of 2.8%. While shareholders faced challenges in 2023, the stock commenced 2024 with renewed momentum following an earnings outperformance toward the end of the previous year. This positive trend persisted into early March, marked by another earnings beat, propelling shares to surge by 12% on March 5th as of the current writing. Hopefully, this video will give you some ideas to spark your investing journey. If you enjoyed it, hit that like button and let me know in the comments what other stock trends you'd like to see covered. And don't forget to subscribe for more content to help you navigate the exciting investing world.